How's it going, everyone? It's Sam. Today I am looking at 5 stocks that are down about 50% since all this happened in the economy and maybe even a little bit before. And I want to say before we get started, if you like this kind of stuff, please leave a like and subscribe below because I'm going to make more of them in the future and it does help out the channel. And looking at these stocks, obviously they are down 50%. There is something that is making people cautious about these stocks, and that obviously should be apparent going into it because they are down 50%, while other stocks like Facebook and Tesla and Amazon are up to record highs. So proceed with caution, do all your own research. I will say 3 of the 5 stocks I am personally invested in, so you might want to think about that too and look at just the key numbers and the key data going forward before you invest in them yourselves. And if you are interested in investing and you haven't started yet, or you just want to get some free stocks, check out the link below to Webull. Get 2 free stocks when you invest $100. So the first stock on this list is Foot Locker. And this is a company that I am personally invested in. I think that they are going to do quite well in the future. If we look at their numbers before all of this happened, back in April of last year, they were up around $63 a share. Now they're at $29. So they've had some worse quarters, but they have a pretty high dividend yield of 5.8% right now. It was up to 7 or 8% there for a while when they really dipped down to about $18. And I was able to purchase, my average cost basis is right around $22. So I have a pretty good cost basis on this and have done pretty well on it so far. But Foot Locker as a company owns multiple companies besides just Foot Locker. They own Champs, they also own Eastbay, and they were able to buy a shoe resale company too. So they have multiple ways of making money. And if you don't know about Eastbay, it is essentially all online and all catalog. There are no stores for Eastbay, and they do a lot of business to high school and college athletes because they hold a lot of different products. And if we look at their key data, they have a lot of cash sitting on the sideline. They have a balance sheet that is very cash rich. And just looking at it, they have about $1 billion in cash. And for a company their size, that's very sizable. They're at less than a $3 billion market cap. So a third of what they own is cash essentially. And they have that nice dividend yield. It is a high payout ratio right now just because they were hit hard this last quarter. But they have been able to grow it at about 11.5% over the last 5 years. So definitely take that into consideration. They have suspended their dividend for now, but once they bring it back, I think they will do quite well. The next stock up on the list is one that I'm sure all of you have heard about, the Boeing Company. So Boeing has had some issues well before anything with the Rona, and they've come down off their highs. They were higher several years ago. If you look at 2019, they were at 440. They dropped down to about 340, so they lost about 20 to 25% of their value over the last year before all this hit. They were down to $95. Now they're up to $150. If you had invested when they hit their low, that would have been awesome. But they are a company that is posed to do very well in the future. They are one of the 2 main competitors in the airplane making space, along with Airbus. And Boeing had a problem with their 737 jets where they had many technical issues. There was some conflict in the company. Some people knew that there were going to be issues and they didn't come forward with them. So they had a little bit of a struggle there. They have decreased in value significantly, but when you look at Boeing, they're one of the 2 major competitors in the space. They're a U.S. company. I don't think the U.S. will let them go under. So that takes a lot of the risk out of the company right away. The other thing is these airlines will eventually need more airplanes. The airplanes are going to get older and older. They're going to have to replace them. And when they replace them, they also get more efficient. So that will save the company's money. So they're not only having to get more planes, but it's also making sense for them to get more planes because they'll save more money. So I think Boeing will come back. It's not a company that I'm personally invested in just because at first they had all those issues. And after that, I felt like there are other great companies that deserve to be invested in. So I went with companies like Foot Locker. But if you want to do your own research, I think Boeing Company is going to do really well in the future and eventually get back up to that share price of about $400 to $450. Now, the next stock is one that I've talked about before. I've done 1 or 2 videos on, and I'm personally invested in it, and it is Scorpio Tankers, or STNG. And this is an oil tanker stock. It's got the largest fleet of oil tankers in the world, and they have done quite well over the last quarter, along with all the other oil tanker stocks. They have made massive profits, but they started to decrease a couple months ago. So right around the beginning of the year, they were at about $40 a share, and then they dropped down before any of this really even happened. So if we look at February 7, they dropped down almost 50% before the Rona hit. And then from there, they dropped down to $13, $12, and then they've come up about 50% since then. So I invested when they were around $17 or $16. They have a really good book value, and they're also earning a lot of cash. So just looking at their book value, it's so much higher than the stock itself that I think that once they produce some good earnings, that they will be able to go up in share price a lot. They have a book value of about $37 per share, and they're sitting at $18 a share right now. So they are pretty cash strapped. They are much more leveraged than a lot of the other oil tanker stocks, and that's mostly because they have a large fleet of ships. They are 5 to 10 times bigger than stocks like NAT. So they've leveraged themselves a lot. So in down markets like this, in down economies, it's harder to get by and get through it. Now, another thing to take into consideration is the fact that these oil tanker stocks really are going to do very well in Q2. So they did decent in Q1, but they're going to expand and make so much more in Q2 just because that's when the oil prices went down, oil tanker stock prices went up, and they are going to be able to show those earnings at the same time that all these other companies are going to show how much they're bleeding. They're going to be down to minuscule amounts of revenue compared to these oil tanker stocks that have done so well. So that is going to be an interesting thing to see when the oil tanker stocks are doing so well and everyone else is showing such bad numbers. Where do the numbers go? But do your own research on that, but that is a company that I also own. Now, the fourth company here is the last company that I own on this list, and it is Walgreens Boots Alliance, also known as Walgreens. So back around the beginning of the year, they were around $60 a share. But if we look further in the past, they were at about $85 a share just a year and a half ago. So since then, they've gone down in price. They have a nice steady dividend with a low payout ratio. So they pay about 4.3%. They've been able to grow this 6.5% over the last 5 years. They've been increasing their dividend 43 years in a row. And when you look at the companies that are really affected with everything that's going on right now, Walgreens isn't in the same boat as other companies. So they've been able to keep their doors open. They've probably been able to increase their numbers when everyone stayed at home. People need more food, more water, more household goods because they're not out and about getting it from other places. So they are going to places like Walgreens to pick up water. When they ran out of water everywhere, Walgreens has water. People are buying water at Walgreens. Same thing with toilet paper, with other household products. They are a company that's open in this time, and they are down significantly from their prices. So I think that is a steady company that will continue to do good work, and I think that you should take a look at them also. Now, the last company I have on here is Wells Fargo and Company. And I have this almost as a placeholder in here, but I think that Wells Fargo will do well in the future. They're almost down exactly 50% over the last 6 months, and they have a nice dividend of about 8%. They have a very high payout ratio, but that's because they've been hit hard with these decreased interest rates. And just looking at really any bank stock, and I put Wells Fargo on here, they're down 50%, but look at some of the small regional banks, and many of them are down significantly from their old highs. I know several regional banks around me that are still producing large dividend yields, but they're really hit hard with these decreased interest rates because banks make money off of the difference between what they can give people and then what they get in return for interest rates. So as they keep on decreasing, their spread gets smaller and smaller. But when you think about it, we're at zero interest rate right now. We're at a zero interest rate environment. We could go negative. People are saying that that could happen. But over the next 10 years, they're going to try to probably bring up the interest rate, just like they started doing in 2017, 2018, 2019. You can only cut it for so long, and then you have to start raising it because eventually you'll have to cut it again. So this really hurts the banks, and then once they start to increase interest rates, these bank stocks usually go through the roof. And, definitely take a look into some of the local banks around you, maybe some that you know of that you can do some research on. Take a look into them because they are slated to do really well once we start ticking back up in interest rates. Now that might be several years before that happens, but they do pay a nice dividend in the meantime. So take a look at them and, do your own research on that. But I appreciate you guys watching. These were the 5 stocks that I really think that could do well in the future that are down 50% still. Now let me know your thoughts below. Are there any other stocks that are down 50% that you're interested in? I appreciate all you guys commenting on different stocks. It's hard for me to be able to research everyone that's brought up to me, but I do my best. So thank you guys for watching. Please again like the video, comment below, get those free stocks from Webull, and I will see you in the next video. Thanks.